Good morning, everybody. For those of you across the ditch in New Zealand, good afternoon. Welcome to our March 2021 webinar. Thanks very much for everyone to join in and promptly logging in. Great to see some regular names come up on the list. Every month there seems to be growth month on month, so clearly I must be saying something interesting for you guys to tune in. For the month of March, I'll jump straight into equities and the equities market. Obviously, our standard disclaimer. So a couple of housekeeping things to start off with. First of all, our roadshows are back. Now we've taken an approach where we're trying to find the best balance for everyone to be able to see something as live as possible. But given the fact that we will always have the uncertainty in Australia with different states taking different approaches to venues and social distancing and whatnot, we've decided to run the one roadshow live in Sydney in the CBD. Most likely it's going to be the Establishment for those of you that are regular attendees of our roadshows in Sydney. It's a nice venue, good social distancing, and our plan is we're going to live beam Renee Hung, who's the PM of both the China flagship strategy as well as the Premium Asia Fund, as well as Gordon Ip, who is the PM of the Asia Income Fund. So it will be simultaneously streamed to other registrants across the country, as well as into New Zealand and our Pacific Island clients as well. And we will be applying for CPD credits. So watch out for that. Put that in your diaries. It is from 12 p.m. to 2 p.m. Australian Eastern Standard Time. So by then we will no longer have daylight saving, so therefore we'll be on the same time zone as our friends up in Queensland as well. So mark that date, and we're most likely going to have invites formally come out in the next week or so. The second piece of housekeeping, just for the purposes of our Australian friends, at the moment, we are vying for a couple of platforms to be included for our Asia strategy. Obviously, our China fund is almost on most platforms available in the country. So with regards to BT Panorama, just to give you guys an update, what's happening there is that if you are part of any transition of clients from BT Wrap onto BT Panorama, then obviously those monies will come across, but you can't add any new monies. All we can do at this point in time is ask you to tell your BDM that you would like to continue supporting the strategies, and then they will accordingly feed that feedback up to the relevant powers that be. We're currently in talks with Colonial First Choice with regards to the Asia Fund, because they are looking for other options potentially in that space, as well as having the Premium Asia Fund return back onto Colonial First Wrap. So the Colonial First Wrap situation is similar to the BT Wrap situation in the sense of the fact that if you currently have funds on First Wrap, you can continue to hold on to it, but you can't add any to it. And then finally, we also have MLC Wrap and Navigator. For those of you in Australia, you would have received a survey asking whether or not you use the platform, and if so, would you support it to be added on both the platforms? They have amalgamated the research process into one group under 360. So if the fund goes onto one platform, it will naturally go onto the other. So please fill that out. It will certainly help us. So everyone's sort of used to this chart now. What's been added in the last month is obviously the big talk around the reflation trade that you see on the left that I'll talk about in a minute, and sort of our thoughts on it from the perspective of an Asian investor. Everything else is the same. We're still seeing very high demand for Chinese equities by investors looking to diversify, especially away from American and other developed economy equities where possible. Just to effectively find a better long-term solution from here on out. And something to reiterate, and I sort of refer to this every month, the Sino US discussions that happened in Alaska were less constructive than what most people would have expected. From our perspective, it is pretty much what we had expected. Remember that the Chinese perspective on things is that the Chinese government will do everything in its power to progress the nation's mission, as well as grow the wealth of the Chinese populace and population. And China will leave everyone else alone. Whereas the United States takes a view of what is called exceptionalism. So effectively that if you do not agree with the US standard of doing things, you are therefore an exception to the rule, and therefore we're going to try to change the way that you do things. So the motivations on both sides is very, very different. The Chinese are trying to be more collaborative, in our opinion, with other major trading partners. And sort of reflecting on that point as well, we get a lot of questions around Australia and Chinese trade. If you look at China and Japan, they have gone through an exceptional period of geopolitical strains. But notwithstanding that, they are one of the biggest trading partners for each of those sides, and they have a great trading relationship. So that's something to take into account when you are looking at the investment perspective versus what is the geopolitical perspective. So recapping, our fund manager, 14 billion US funds under management, split between 4 billion in fixed income and 10 billion in equities and multi-asset. We have 70 investment professionals on the ground, and that's sort of what we are coveted for in terms of our competitive advantage against our peers. And while having our offices in Shanghai, Shenzhen, KL, Singapore, and London and Beijing, it gives us the most on-the-ground coverage, which leads us to doing at least 6,500 company visits per annum, in which last year we broke all records and did 8,600 company visits, excluding AGMs and broker events. So all the engagements that I'm referring to here are all one-on-one. So let's talk about what happened in February. We're now in sort of late March, and this whole talk around the reflation trade. Okay, so obviously, the whole world has been waiting for inflation for an exceptionally long period of time. And there was a huge change in market sentiment over the course of February with the steepening of the yield curve. Now, what you have to also remember in light of that steepening of the yield curve is the fact that every central bank was effectively trying to buy bonds in the market to push down those yield curves. And what's the reason for that? Because they want to keep yields low. They don't want to risk the global recovery. And then that also leads to the fact of both, let's say, Australia as well as the United States have declared that it will be a very, very long time before they'll be able to comfortably raise rates. One thing to note here as well that I think is very, very important. Sorry, I don't know what's happened here. One thing to note here is that what's also occurred is, as part of this rotation, the highest growth sectors were the ones that were sold down. So this is not necessarily just an Asian equities phenomenon, there was the global phenomenon as a whole. And while we consider this reflation trade to ultimately would have happened at some point in time, it doesn't change the view that we think that this is going to be a full rotation from growth to value, but we do think it's going to be a balancing out of both traditional growth and traditional value stocks throughout the rest of this year. Remember that the drive to of the correction that we saw is based on the fact that if you have a steepening yield curve, you then have a different discount rate that you need to apply to then achieve what you would believe to be a acceptable level of PE, and that's what drove the valuations down. This is very different to saying that the stocks were corrected on price based on a change in fundamentals, because the fundamentals had not changed. And if you also assume that all the central banks are trying to, whether it's artificially or organically, trying to maintain the interest rates to be at a continuous low point heading into the future, it is still important to note that what you need to remember is that it doesn't change the underlying fundamentals of the companies that we're investing in. So recapping again in terms of what you see here with our investment themes from last year, and the fact that we did 8,600 due diligence meetings over the course of the 2020 calendar year. And this is the chart that is effectively supporting the main reason why people are shifting away from US equities and other developed markets and more into Asia, is because of the fact that you are looking for more attractive PEs, but at the same time, you're looking for those companies that have a stronger level of free cash flow. And effectively, since 2000, in the early 20noughties, you would have seen that Asian free cash flow has been stronger than Western counterparts. But ever since the Asian financial crisis in 97, 98, the gearing ratios have been lower. And when you're faced with systemic risks, such as a pandemic where companies have to shut down and economies have to shut down, what you then find is that companies with lower net gearing ratios is obviously going to be your safer bet. Now, this is going to be the year of normalization. Our earnings forecasts are showing that Korea will probably have the strongest EPS growth this year, followed by quite a number of ASEAN nations, solely because they were more greatly impacted than China last year. So if you're looking for the earnings recovery story, that's going to come off the back of EPS growth in Asia. And then at the same time, China will hit around 8% GDP growth this year. That's not greatly relevant to our investment thesis or how we allocate money because we're bottom up, we're not macro specialists. We're just looking for the best companies with the best level of earnings. So just recapping as well, the transformation of China is a continual process, and the Alaskan talks between China and the US were probably a great example of what's happening going forward, in the sense that China is shifting to this demand led world, or demand led economy, and therefore as part of that, they're going to do everything in their power to progress, regardless of whether or not the US is going to keep talking about Xinjiang, Hong Kong, and Taiwan. They will keep talking about it for the next 30 years. It is simply a distraction from the macro picture. And that's something that I cannot stress more heavily. When you have a consumer and a population of 1.4 billion people, and they're only going to grow, and that by the end of this current decade, China will become the largest economy in the world, you have to remember that the US feels strategically threatened by that in terms of its global superiority. So which is why the US will always have ships circling South China Sea. They'll have, other deployment carriers across Pacific oceans and Pacific islands. China doesn't deploy its aircraft carriers anywhere near Los Angeles or New York. It's not interested in it, okay? Because they only care about the development of China itself, not care about other people's backyard, which is the healthy way to go. Now, we also have had a big focus on what you see here in terms of online versus offline businesses, with the online businesses having a far better model going forward in terms of its ability to be able to pivot, more variable costs, less fixed costs. And a lot of the businesses that we're investing in now are trying to pivot a lot more to the online side of things, which is fantastic to see. And the difference between online and offline is a massive 16%, as you see here. So for those of you that ordered anything during the COVID period, during lockdown, you may not have been home, or you may not have been convenient to pick up the good. It was delivered to a pickup point. And at that pickup point, that news agency or a grocery store or something is paid on a per piece basis to help with that delivery process. So therefore, you're not having these deployment centers or disbursement centers that is having a very, very large fixed cost. And the thing to note as well is that going into the future, with the highest percentage of consumers in China being millennials, they trust local brands more than they trust foreign brands, solely because of the fact that they grew up with a lot of the local brands, and a lot of local brands now, or most of them, are providing very, very high quality goods and services. So it's very, very important to note what's happening in that space, just in terms of the change in the consumer mentality. So one of the sectors that I want to deep dive into today is around healthcare. And healthcare is a very, very big deal in China because since 2009, after the GFC, the Chinese government embarked on a massive social program because China is going down a socialist path in order to allow the populace to be able to access universal healthcare, universal education, as well as a pension system. So what you see on the screen here is that back in 2009, China provided less than a very small proportion of what we call innovative drugs. They were all effectively drugs that were generics because they didn't have the R&D capability, they didn't have the know-how, skill set, or the firepower in terms of monetary firepower to go and do the R&D required to achieve an innovative drug. But today the situation is very, very different. So as you see on the slide here, China has the cost competitiveness advantage against the rest of the world, especially the United States, which is very well known for obviously innovative drugs. So the staff costs is about a fifth. The total R&D costs is about 10%. So 90% discount, and they were effectively creating the same amount of drugs, innovative drugs. And the cost of their against total revenue for R&D is actually about 3% less, which is fantastic. Obviously, Chinese drugs are selling for less because they can command only a lower price compared to their US counterparts. But what you see here is in terms of the R&D spending overall, in order to get to the same amount of innovative drugs that are being developed, you're only spending 3 billion as opposed to 82 billion in the United States. Then if you then break that down, and this is why this is a very, very long-term structural theme that we're investing in for both the China Fund and the Asia Fund portfolios, is that you see here is the CAGR growth of the innovative drug portion of the revenue lines is about 27% for the next 4 years. Okay, and then what you see on the right-hand side there is that that blue part, for these are 5 Chinese pharmaceutical companies that we look at, and some of them we invest in, is that you look at the growth of that blue part. Okay, you always have, you know, the mustard colored and the gray colored part, which is the generics. You will continue to see some level of growth there. But the thing that makes money and that brings the dollars through the door, that makes you highly profitable and obviously more scalable, both from an R&D perspective as well as the ability to then sub-license your innovation, which I'll go to in a minute, you will see that importance flow through going forward for each of these companies and effectively what they're trying to invest in. Now, we in 2012 did start investing into pharmaceutical companies. CSPC, for example, was a big holding for us. But that theme and that thesis in 2012 was very different because we were investing in a company that had effectively the largest market share of generic distribution in China. And when everyone in China is receiving at least $50 in universal healthcare a year, which includes access to generic medicines, CSPC was a great investment for us. But the thesis has changed now. We want to invest in the innovative producers. So the example here is Innovent Biologics, which is a Chinese company listed in Hong Kong. And what they do is that they focus on biologics. So for those of you that are not familiar with the biologics industry, biologics is medications that have a live organism component. They do include some vaccines, but the effective baseline requirement of a biologic is that it has a living organism as a basis for the medication. So these are a lot of injection type drugs. They do cost a lot more to develop, obviously, because you're playing with a live organism as part of the R&D process and obviously the manufacturing process. But the reason why biologics are very well known or very well used across oncology, people with overactive immune systems and things like that, they're a critical part because they're like a smartphone. So think about going from a Nokia 3310, where all you could do was effectively make a call and do a text message, to what you have in an iPhone now, where you can do effectively everything that you want on a small device. And the reason why biologics are great in that sense is, instead of taking an antibiotic, which will effectively indiscriminately destroy your immune system and wipe you out, it takes the opposite approach. And actually tries to find the parts of your system that it's trying to target, and trying to find the faulty ones or the ones that are sick, and basically leave the good ones alone. And this is why the biologics market is growing exponentially. And for those of you in Australia, you will understand the system of the PBS, so Pharmaceutical Benefit Scheme, where the government is effectively subsidizing the cost of medication. China has got NRDL, which is the National Reimbursement Drug List, and Innovent Biologics, their biologic, achieved that inclusion on that list, which you could imagine is a great achievement, which then led to a 178% year-on-year growth in the first half of last year for that biologic that they have. Furthermore, in August of last year, they also granted Eli Lilly, for those of you that understand the pharmaceutical industry, they also included a huge exclusive license for them, which will generate at least $1 billion US in license fees. And so we had been looking at this company for a while, and we invested, as you see on the bottom right-hand chart there, in June last year, just shy of $100. And then we have started trimming our positions. We've trimmed about half our position here at around the $200 mark as the sell-off started to happen. So this forms a position in both our China fund and Asia fund, which you'll see in a minute. So with all these webinars, I get emails every month and asking us about or ways to improve the webinar. So please keep those emails coming through. We do shape these webinars to your liking and what you want to focus on. So one of the questions that we get asked a lot about is, yes, that's great, Jonathan, you keep showing up a line chart showing your outperformance against MSCI Asia ex Japan as well as Platinum. But what does that look like from a year-on-year basis? So what you see on the right-hand side there is that you see this as every year, year-on-year. For the 11 full years of track record, we have outperformed Platinum in 7 of those 11 years. If you include year to date, that's 8 out of 12. And on a cumulative basis, net of fees, we have outperformed Platinum just shy of 80% total net, in which for the first 10 years of the strategy, it was trading, it had a fee regime that was far higher than Platinum's, and now it is cheaper than Platinum's. So for those of you that are considering how you want to mop up your Asian exposure going forward, we certainly would appreciate your support if you think it is a right approach for your client portfolios going forward. Investing with a brand is very different from investing in a fund. A brand doesn't mean the product is great or worse than your competitors. So year-to-date performance, our Asia fund has held up very, very well against the indices, and the China fund's obviously taken the larger correction compared to the Asia fund because of the fact that we have a high bent towards the Chinese technology names in the China fund. There, all the research is covered. Please reach out to your BDM to get access to the research if you need that. And then just an update on the performance against our peer groups. This is the entire Morningstar peer group updated to the end of February. So our excess return over the 1 year is about 15% against our peers, and over the long term, over 10 years, it's about 300 basis point net of fees outperformance. But we've done it under every time frame, 1, 3, 5, 7, and 10 years, with a more superior Sharpe information ratio, representing the fact that we are actually taking less risk per unit of dollar returns that we are generating for your clients. So rest assured that we take our roles very, very seriously, and that what we do here is purely trying to generate a best risk-adjusted return for your investors. There hasn't been a huge amount of change in the portfolio over the last month. We're still heavily bent 2/3 of the portfolio to tech. As we said, we did a lot of navel gazing last month just to review whether or not our thought process around the structural changes that form most of our portfolio Have they changed based on the reflation trade? Our conclusion is no. So therefore, we didn't make any knee-jerk reactions to having to go and reallocate our portfolio. So that's the Asia fund there. Here's an update to the top 10 holdings. Our position in Innovent Biologics, as I spoke about before, just falls just outside of the top 10 for the Premium Asia Fund, because there's the slight dilution by having the non-China parts of the portfolio, including Korea and the other parts of ASEAN. But even with a 2/3 bent to new world technology companies or new world consumer stocks, our P of our portfolio is 17 times. You'd be hardwired to get anywhere lower than about 25 times in developed market equities. And you can see there also our contribution by attribution over the last 12 months, which we'll keep keeping you updated on, because everyone keeps asking us about where you're actually generating your returns for investors. In terms of our China fund, that's our 15-year track record that you see there, outperforming the benchmark by about 255 basis points per annum, net of fees. So that continues to be very, very strong. In terms of the sector exposure, reasonably similar to the Asia fund, except obviously given the fact that we've got a higher bent to consumer discretionary through a lot of the white liquor names, which we've also trimmed a bit back on during March, which I'll update everyone in the April webinar. We've taken a bit of profit on the back of that, which has been good to then consider other opportunities within the portfolio. And you can see here on the top 10 holdings, you can see Innovent Biologics sits at a, apologize for my phone going off. That's the Innovent Biologics here at 2.8% allocation, and the P ratio obviously for the China fund is slightly higher at 21 times, with our contributors and attributions that you see on the right hand side all around those consumer stocks. So that's all I want to cover off this month. For those of you that registered at 2:30 p.m, I'll be giving an update, a monthly update on the fixed income strategy. This is a chart that I've updated to the end of February, where effectively 95% of the debt of the world, both corporate and government, is paying less than 1%, which is amazing to see. And I will be covering off this chart in the next webinar because I am genuinely shocked as both a fund manager as well as an advisor as to why people are still more than happy to still put money into government bonds and tell their clients that we're going to generate these sort of yields for them, because these yields actually do not exist anymore. And I'll go through that in the next webinar, because while you're creating a cash yield, you're also forgetting to tell clients that you're actually going to lose money every year on the capital value. And then furthermore, are you telling your clients that they're going to pay $111 and $109 for a $100 asset today? So with that, these are our contact details as always. Please feel free to hit us up for any further information. A copy of the slides will come out to you guys as always. And hope everyone stays safe. And just a reminder, 1st of June 2021, we will have our first live roadshow after taking a break from last year. So have a great day, everyone, and see you guys soon.